Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right. Welcome back to the Gentle Art of Crushing It podcast. My name's Randy Smith, and I'll be your host today. And really excited to have Drew Breneman with us today. Drew is the founder of Breneman Capital. He's got $250 million in AUM, primarily in multifamily, and he focuses in Chicago. And he's had a number of different exits, averaging 24% IRR. So, Drew, welcome to the show.
Thanks, Randy. Appreciate you having me on.
Well, let's jump in as we always do. Can you give us your perspective on the current state of the market and how that may or may not be impacting the passive investor?
Yeah, I mean, it's interesting. It's really, so I have a unique perspective where I own, like you mentioned, apartment deals in the Midwest, in Chicago and also in Wisconsin. And then I own still some shopping centers in Minnesota that I bought with my first investor, and as well as some apartment deals in Phoenix that I bought 4 or so years ago. So it's interesting to see in the deals that are for sale in those markets and the performance of the properties, because it's a total 180 from what I would have predicted, 3 years ago, where at that point the Sunbelt was growing so fast, and Chicago and Wisconsin, they're just growing whatever 1%, 2%, 3% every year. Slow and steady seemed so boring compared to the 8 to 20% rent growth of the Sunbelt. So really, that's what I think people should be, aware of is, you've had this tidal wave of supply hitting the country, but it's really all in the Sun Belt. So, like for example, so I live in Austin, Texas now. I grew up in Wisconsin and then lived in Chicago for my whole life until 2 years ago. But I'm in Austin now, and it's funny to compare the markets in a way where Austin obviously is growing very fast for population and job growth, but it has 15% of existing inventory under construction for apartments. And that same calculation in Chicago, it's right around 1%. So you have, 15 times as many apartments, on a per unit of existing stock comparison being built in Austin. So then, while on paper you'd think, well, Austin must be booming still on the apartment side, and it's, it's hit, a slowdown, and so is most of the Sun Belt, as a lot of, LPs would have noticed. And then on the flip side, I've had the best 3 years of owning in Chicago that I've ever had. And I bought my first deal in 2013. The last 3 years have been the best three, where we've been getting on average 8% rent growth on our buildings. And that's existing ones where I thought we were really pushing things on rents. But yeah, we have, one building the first one I bought, I was getting $3,650 was the most I ever got in rent up until 3 years ago. And we were renting units for $4,200 now.
Unbelievable.
And yeah, so it's been a surprise to me in Wisconsin seeing the same thing. We bought a deal in Madison last year, and the new leases on average were 16% higher than the in-place leases. The reason we bought the deal was that year they had like 90% renewals. And so that was only on a small sample size. So we bought that at like a low, mid 5 cap. And once you reset those rents to market, we're all in at almost like a 7 yield on cost. So then that's kind of a no-brainer. So that's what I'm seeing today. And I think that will, I don't think that will continue forever, where obviously you're not going to get 8% rent growth anywhere forever. But I think, you still have a couple more years where the Sun Belt needs to work through this supply issues. And then the Midwest just has nothing in the pipeline. Like Chicago on average had 4,000 units a year built like the last 20 years. The next 3 years, there's 200 units per year total in the pipeline, basically just one deal a year finishing. So
unreal. Okay.
So yeah, that's how I see the market today. Obviously there's a lot going on with inflation and jobs and interest rates and tariffs. But I think at the end of the day, apartments is still supply and demand. And, maybe some of those other things I just mentioned could slow the demand down a little, but right now it's really like a supply story where you have, 15 times the amount of new units hitting some of these markets.
Yeah, no, thank you for that perspective. We've not spent a lot of time on the show talking about Midwest markets, so it's good to get your perspective, and we'll want to dig into that more because I know you've got a pipeline of deals that are coming up, potentially something coming very soon. So we'll dig into that. But before we jump into those kind of details, can you tell the audience a little bit more about yourself? You mentioned you grew up in the Midwest, Chicago, Wisconsin area, but tell us a little bit more about Drew.
Yeah, I'm from the Milwaukee area. Both my parents were teachers there. And then, how I kind of got into real estate was I started an internet business in high school and made somewhere between $80,000 and $100,000 over a 4-year period total, not per year. So I saved the money and started looking at what to do with it. And
In
really
high school, you said?
Yeah, correct. And I saved it all. I literally spent zero. I already owned like a $500 car, and then just had my clothes already. I didn't spend anything. I just saved it all, and then wanted to look into what to invest in. And so I read all these books people probably normally read when they're like 40, like Rich Dad Poor Dad and Think and Grow Rich. I started reading about real estate investing, and I really liked just how you made money in real estate with the cash flow, the building appreciation, paying the loan down, the tax breaks. It's not as a low correlation to other investments. So I figured, okay, I got into UW-Madison. Just it's the best in-state public school, so got in there, and then I decided, why don't I buy my first property when I go to college? And so I did. I made my first purchase as a freshman. I bought a duplex, moved into it for my sophomore year, rented out the bedrooms in my unit, and then leased the upstairs unit. And that was my first deal. Very simple. I had a lot to learn, so I just focused on that it was cash flow positive, so understanding what the rents would be and the expenses. And then on that size deal, everyone was just using gross rent multiplier, so it was at a lower than usual gross rent multiplier. So I bought it. And then I did one deal every year after that. And I bought about $2 million total in college, which I remember being surprised by, just that I had already bought so much. So then as I got into these bigger deals, I'm still, surprised to an extent how things have grown. But yeah, then I majored in real estate. So it was where one thing that was super fortunate is UW-Madison has the number 1 or number 2 real estate program in the country for college. Depending on the year, it's either UW-Madison or Wharton. So got my real estate degree and then started working for a developer up in Minnesota, apartment developer. And one of the interns there, he was like, why don't we go talk to my dad? Maybe he'd want to invest. And kind of brought some deals to lunch and showed them what we could do. And they liked it. And, to fast forward a little bit, over the next 10 years, we bought right around $100 million of property together. So the dad, he didn't invest like 20 or 30 million, like what you would need to buy that all in one shot. It was, he invested less than 10, but it was just through recycling the capital. You buy something for, 3 million, make it worth 4, do a cash out refi, pull maybe that million you put down out, buy a second deal, or sell the property and trade up into a bigger one. So I've done 14 deals where on average I've done, refinanced out 100% or more on average on those 14 of the initial equity. And then over different time periods, some of those I did it as quick as a year, and others, it took 4 or 5 years to do that. So a lot of cash out refis. You don't want to do that on every deal, max it out the leverage to the top. But that's, that was, maybe at that time, we're doing 1 or 2 of those a year. So it's not on every property where you're re-levering it up to the max.
Yeah.
And then, and then in 2019, just opened it up to other investors, and now just have, every, basically any accredited investor can invest with us. We have people who have invested 50,000 on up to, 30 something million, with me. So
unbelievable. Wow. It's such an inspiring story to hear that you were able to start in high school and do what you did in high school, and then take that cash in your sophomore year in college and start, essentially the house hacking model for your first property. So you hear a lot of people talk about that strategy, and it's what I suggest to folks. Like if you're just getting started and you're young, house hacking is the way to get started, I believe.
Are you interested in real estate investing but don't know where to get started, or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
It's that FHA loan where you can put only 3.5% down.
Yeah.
So yeah, I 100% agree with you, Randy, on that. Especially, because I'll have calls with people, and sometimes they're, if they're not accredited, we're just set up where we just only take accredited, just to, I think, just to keep it simple from my end. And then But so I always, especially if they're more willing to be active, recommend exactly that: house hacking, get a owner occupant loan, be in there a year or two, and then move. Keep doing it till whatever, you have too many kids or can't do it anymore. So that's the way to go, I think. So
Love it.
yeah, a lot of
So
those.
did you do?
Yeah.
You said that you bought another house each year. So were you doing that same thing? You were moving to the next house,
Some of them,
3% loan.
yeah, some of them. And also too, one thing where I was fortunate, I got started in 2005. So, I was able to get loans because I had income from the internet business, but you didn't need income back then to get a loan. You could, you just whatever, say you have income and they were giving you a loan, but you would get a much better rate if you had, a documentable income, which I did. Since I reported that internet business income. And so yeah, the first one I lived in. Then the second one was I did not owner occupy. That one I did actually a second mortgage on the first one to fund most of the down payment on that one.
Sure.
Then the third one was also not an owner occupant, but then that one I just put in new money on. And then the fourth one was owner occupied.
So it's funny when you think back to 2005 they were giving loans to anybody. And it's funny, like you would be kind of like the punchline of a joke. Like if a freshman in college comes to you and says it's a great time to invest in real estate, it might be a little too much. But fast forward here 10 or 12, 15 years and look at what you've accomplished. That's amazing.
Yeah, thank you.
Well, let's kind of dig into this a little bit. We had some different thoughts on how to take this conversation. You are in a situation. I think it's interesting that you made the move to Austin. You bought some assets in Phoenix, and now you're back and refocused in Chicago. Maybe not refocused, maybe continue to be focused in that area. So can you talk to what kind of caused you to start looking at the Sunbelt and, how you landed in Austin as well?
Yeah. So I think starting to look at the Sunbelt, it was, just as simple as I was kind of saying in that quick intro was you're seeing the whatever 1% to 4% rent growth the Midwest had been getting the last 10 years. It seems so, unattractive compared to what the Sunbelt was doing, because also Sunbelt was having so much cap rate compression. I mean, you had people buying deals and, in some places where they bought something in 2019 and they, 2.5 times their money selling it in 2020, in the back half of the year. And then also at that time, with, Chicago COVID was a negative impact for Chicago where, our rents went down in 2020. I think we're flat in 2021, came back in 2022. We're way past where we were even, pre-COVID, obviously. But so it was more just you're looking around going, wow, this place has such high growth. In Phoenix in particular, I don't have the exact numbers in front of me, but I remember going, okay, let's calculate what the rent growth was when it was, let's say, normal time. So 2014 to 2019. So no GFC rebound, no COVID bump. And this was from either CoStar, Yardi, or Zillow. I forgot which source we were looking at, but it was 9% a year rent growth, 8 or 9 in the normal years. I remember thinking, okay, if we can even get half that, this would be, great. So that was the thought of looking to the Sun Belt, and then we landed on Phoenix because of how the operating costs function there. You have your biggest issue in the Sun Belt is insurance and property taxes. Living in Texas, we have every sort of natural disaster, basically, I guess, except earthquakes here. And then so insurance is not cheap. And then these 0 state income tax states, they have very high property taxes, and they are aggressive at assessing them. Your average deal, this would, surprise everyone, I'm sure, but your average deal in Texas has higher property taxes as a percentage of the rents than Chicago by maybe 50% higher. Where Chicago, actually, the way that functions, that the taxes are modest. They're lower than what you would find in Wisconsin or Minnesota. And the state, they can't chase the sale price. So they're kind of guessing on where the values are, and they're not fully assessed. I'll just leave it at that in case the assessor's listening, which I'm half kidding, but they are.
Sure.
But the tax rate is similar to Texas. It's about 2% of the market value equivalent of the assessed value. But in Texas, they are very aggressive at keeping you at 100% or even over assessing you and forcing you to appeal to knock the taxes down. Whereas in Illinois, though, they are underassessed on the assessed value side. Then, so I was already, very aware of that from looking, at taxes in Chicago, and then Phoenix and I think Arizona and as a whole, but definitely Maricopa County, they have a 5% per year assessed value cap on the increase. So you go, okay, that's kind of, we know our worst case. And also a lot of these taxes are is very low because they've had a higher than 5% growth. So, we have a 25 or so $1 million deal in Phoenix, and our taxes are like 40 something thousand a year only. And we have a similarly priced deal in Chicago, and our taxes are, hundreds of thousands a year. So it's not, yeah. So that's why we landed on Phoenix. It was having the growth. It wasn't, it wasn't number one. If we wanted number one rent growth, that was Boise or Tampa or, what wasn't Phoenix. Phoenix was definitely up there, but wasn't number one. But you got to factor in the operating costs too. And so that's why we landed on Phoenix.
Okay, very good. So now I know a lot of people, the Sunbelt got a lot of attention. It brought a lot of people like yourself here. There's been some challenges in recent years in Phoenix. So I'm curious, how are the assets that you bought in Phoenix performing, and what do you see for the outlook for those assets?
Yeah, I mean, when people ask me, I just really shoot them straight. I mean, in terms of the deals that I've done, I've bought 42 or 43 deals at this point. Those will be my worst 5 deals, 1 through 5. I don't think that we will, there's only one where it's, I could see where it's possible we could lose money on. That we'll see how, where things are in 2 years when the loan comes due. But we were, I guess, fortunate to an extent that we bought all deals that had upside. So we were able to raise the, if I wanted to give you like the, an answer that was all positive, I could have told you we raised the NOI on a lot of these deals 50%. But, that doesn't really matter if you bought a deal at, a 3 something cap and brought it to a 4.5. That's not so great if they're selling, for, a 5 today or whatever. Those are not exact numbers, but just fortunately though, 4 out of the 5 deals, we did all fixed rate loans from a bank. So we have 3.5% fixed rate money on those, 5-year fixed. And then another one was a 7-year fixed at 4.25. And then the one that we did floating rate, we just did the math and said like the best thing to do on this will be we should do a cash in refi, put in more money, pay the loan down, but at least now we're cash flow positive. So we actually just applied for that refi now. And so, yeah, we're going to be adding money to it, but then we're refinancing where we'll have, hundreds of thousands of dollars of positive cash flow and at least fix the problem, so to speak, where I think, and I was fortunate that I had an investor just on that deal, a single family invested in that deal. And then, so you just need to explain this to one party. And if they want to go with it, and I contributed money too. So then just me and him need to contribute the money to do it. It's obviously harder if you have 100 people to go convince, but just from my perspective, you could limp it along, raise, additional equity. But if you still have this floating rate loan out that, the way interest rate caps are priced is basically like prepaying your interest. It's not exactly that, but it's pretty dang close. So then it's like you're paying 7-8% interest still on this deal that maybe, unlevered is a 5 something, a high 5 yield. Like you're still cash flow negative. Like you want to fix your problem, so to speak, with how you set the deal up with the loan you chose. So that's what we did. So yeah, we'll be all fixed rate, as of 2 months from now on those. And then we just have one that, we didn't move the value as much as we thought. And that will be harder to get refinanced and keep going. So that will be a similar scenario potentially on that one. But then that's 2 years out. So and it's an interesting thing how it works out. I mean, I spend more time on those 5 deals than maybe all the other deals added up.
Sure.
And, at this point, we're just completely working for free. We're not charging any asset management fees or, our promote starts at an 8% return. I doubt we're going to make over 8 on these. Should be a positive number, but I don't think it'll be 8. So but I just want to make everybody whole, have a positive return. So I'm here for it as long as they want to keep going as well.
Well, and thanks for getting into that. I didn't plan on going into that, but obviously I'm invested very heavily. My investors are invested heavily here in Phoenix as well. So I'd love to get your perspective on that. Kudos to you for showing up the way that you are and still working so hard for your investors. There's a lot of groups out there that are not doing that. Fortunately,
I had
I've been
someone
able
who does I don't want to give him away almost, but someone who's in the debt space.
to.
He
Sure.
told me that. He said you should just throw these things away and move on to something you can make some money on. And I was like, yeah, I don't really feel right about that, but thanks for the feedback.
Sure. Sure.
But I think, yeah. And the other thing too, I mean, I'm very open about it, because to me, it's like, it's just math at a certain point. Like, okay, this thing makes, with no debt, a high 5% return. So how would we ever get out of that hole if we're borrowing at 7% interest, or we bring on a pref equity lender who will lend us money at 14%? Like, I don't see how we get out of that unless whatever, cap rates go back to 3% and, rent growth goes to 20 again. It's really hard to get out. So I think, just for my own perspective, I wanted to get, that deal, assuming my partner was on board, just I had the luxury of going, okay, we can rip the Band-Aid off, add the money, and then have this thing cash flow. I do think that Phoenix, is still a great market. It just had way too much supply, and then does have financially speaking, a weaker renter pool than a lot of the cities we've invested in before. So I think I'm maybe more worried about like a renter we have in Phoenix, like if we have a recession coming up,
Mhm.
where that's kind of your typical, your average income. Like, they're not low income housing or anything, but our Chicago deals, they're I mean, like during COVID, we collected 100% of the rent. We had zero issues. I mean, most of our tenants make either as a unit with six figures.
Yeah,
So
that's amazing.
it's a different animal on the Phoenix ones. We're renting to just normal normal folks.
Okay.
Where they could I feel like be more impacted, where these they'll have less savings, etc.
Sure. Well, let's shift gears a little bit for about a brighter story about some of the projects that maybe you're working on in Chicagoland now. You had mentioned earlier that you've got a potential tax abatement deal. I'd love to dig into that if we can, and educate the audience on what that market presents and provides to passive investors.
Yeah, and I think too, if when you say, yeah, why Chicago, or why are you looking there? I think the main thing for the Midwest, and especially Chicago right now, you have above average cap rates, so you'll have higher cash flow starting out. You have higher than average rent growth, and you have very, very high occupancy and collections. Our portfolio in Chicago runs at somewhere, depending on the building, 98 to 100% occupancy and collections every year. When someone, their lease is ending, let's say 3 months out, we ask them if we send them a renewal email. They need to tell us within 30 days whether they're going to renew or not at the new rents. And then if they are not, we start showing the unit while they live there and get it rented for the next day. So if we're doing 0-day turnover is the term, I don't know if it's our term or whose it is, but we turn that unit over on the day they move out. So let's say if they move out on April 30th and the new tenant moves in May 1, we're showing up, because there's a time in the lease, like the lease ends at 10 a.m. Like, we're showing up at 10 a.m. to turn the unit. So it's
So how do you turn a unit in less than 24 hours? You can't even clean carpets. I can't imagine in that.
yeah, there's no carpet in pretty much any of these places, at least. Yeah, so it's just you're painting and then cleaning right after. So, and
No
then
kidding.
any basic repairs. I mean, and this is what's funny is this was normal for me because I had those college rentals, and that's how Madison functioned. Everyone
Sure.
moved out in the whole city on August 14th, and then move-in was August 15th, and
No
all
kidding.
the renters were homeless for a day if they didn't renew. Yeah, it's
That is wild.
very weird
Yeah.
market. Yeah, so you'll see trash everywhere. Because these college students not too, careful where they put things if they got an old couch to throw away. So yeah, the city just comes around and picks stuff up
Interesting.
all day. Yeah, and so I was kind of used to that. So I thought that was just totally normal. Like, oh, you're moving out on
Sure.
April 30th. All right, I'll get this thing rented for May 1. And
Sure.
and then you just give them 48-hour notice to enter and show the unit. And so yeah, that's why I like Chicago. And then this deal we're buying now, we really focus on buying newer, nicer, well-located deals that have cash flow right away. We want to have some sort of upside as well, but we're very focused on the neighborhood, the city, the micro location. It could be in the best neighborhood, but if it's across the street from, for an extreme example, a cemetery or something, I'll just pass on it without even really looking at it. I think the deals that are built really well in great locations, they just do better over time. So we kind of use that as a starting point. And then want deals that have some sort of upside. Typically what that looks like is, and because we have so many properties in Chicago, we're really dialed into what the rents should be. So we're buying deals where, the rents are below market. That's just typically what our deal profile, where we don't need to do any rehab. It's just, we know it should rent for this amount and they're charging $400 below what they should. And a lot of these, I guess if 400 sounds like a big number, a lot of our rentals, like on our, 2 bedrooms for, $3,500. Like that's a typical rent. And so, yeah, this deal is pretty similar to that, except we're buying it, off market direct from the seller. So there's a bit, I don't know if I want to put it on a podcast, but they were told they got a higher offer at the time we were going to contract when they had told the broker they know that was that this was selling to us. But it's off market just from is someone that I essentially have just known for like 20 years. And then the upside for us is the tax abatement, where we would in Chicago on any new build, you already have to have 10% of your units be affordable just to get your building permit, essentially, or zoning change. For the zoning, you need to do that. And then the county has an incentive where if you have 15% of your building affordable, you get a 25% tax abatement and a lower assessed value. So for rough numbers, it's like your taxes get cut in half. So this is accretive to the returns when you are buying a deal that already has 10 or 15 or 20% or affordable. In some areas, you need to go even higher than 10. But if you're buying a deal where it has no affordable starting out, it usually doesn't pencil. But for this, it does. And then, we're starting out buying this at, let me grab it, in place, 5.73 cap rate. And then with the tax abatement strategy and marking a few leases to market on the rents, we can get to a 6.2 just yield on cost on today's numbers. So, untrended. Okay. And then with the growth, we have this penciled as a 5-year hold. This will grow to a 7 cap. So just where the number one metric I like to use is unlevered yield on cost. So just your, NOI that you would, untrended yield on cost is what I like to use. And so like how I look at this is okay, I implement the tax abatement strategy. It's like I bought this at a 6.2 cap. Deals like this are selling in mid to high 5s today. So I know, just to keep it as simple as possible for myself, at this gut check, I know we're making money on that. Like that's cash flow positive. We got a lot of built-in upside. And then I want to see what, cap rate we grow to over time and do the same thing. Like these deals, before interest rates went up, would sell for around a 5 cap, and we'll have this at all in at a 7 cap. It's a big spread. And so, then we'll start out, we have a average cash on cash over those 5 years of 5.9%, projected equity multiple net 1.85. So, it's, so the returns are great, I think, relative to the risk. And this is the kind of space we play in where, there's no rehab, and even executing this abatement, we meet the criteria as long as we rent, 2 or 3 more units affordable. And then the attorney we use for this, as long as their clients have met the criteria, they've never got a denial, and they're 220 for 220 on getting these. So
can you talk a little bit about, we haven't on this podcast and with my investors, we've not done a lot of newer vintage assets. So you're talking about much higher cash flow throughout the whole period than other deals that I've done, but the equity multiple is lower. Can you talk about how those dynamics or the dynamics of these type of deals impact the long-term returns on these, and why?
Yeah, I think, there's less, value being created, which I think is probably what shows the higher equity multiple compared to buying an older deal, doing like a big rehab, re-renting it, refinancing it, executing all that. So yeah, I think your value adds that have higher equity multiples, but that's all driven just on the value creation. If you're looking at, let's say your, a Phoenix deal where it's buy, rehab, then sell as the plan. I mean, that you're going to have basically no cash flow because you're going to have, you're taking units down to rehab them. And also Phoenix is still a lower cap rate market than this deal we're comparing here in Chicago. So you're going to have minimal cash flow. I mean, some people will pay out their reserves during that time period just to have some cash flow coming out to investors. We don't do that, but just that's, sometimes people do that to generate some cash flow, but then that's, so that's all just value creation really is the comparison, where we have more of a mix, where on our deals, we always in our pitch decks have a chart, and usually the percentage of return from cash flow is somewhere between 30% and 50% on our deals. So there's a lot, it's a lot more insulated our returns than, let's say, a value add deal, because they're already being generated. It's the cash flow from the property. We don't need to execute a rehab, a refinance, and then sell the property to have our returns. So we're already getting half. So yeah, the deal I bought in Madison last year, one of our potential LPs who did invest, he asked me to, like, a crazy stress test scenario, like, okay, no rent growth for 5 years, expenses grow at 5%, and you got to refi, like, I forgot what interest rate, a really high one, then sell it at a 8 or 9 cap.
Sure.
And it actually had a positive return. It was like it was 2%. But when I loaded it up, I'm like, okay, let's see if how much money we lose on this thing in this scenario. And actually, no, it was still positive, because we had starting out with high cash flow, and so with those assumptions, over time the cash flow went down, and then we sold the building at a slight loss, but then had in this hypothetical, but it still had a positive return because the cash flow was so high.
The cash flow. That's amazing. That's a metric. That's a metric I've never actually looked at or measured on projects, but this returns from cash flow at 30 to 50%. That's amazing. Absolutely.
Yeah.
Amazing.
Some people, I don't know. I don't think this is not IRR based, but also some people IRR partition, which is breaking out what part of your return is from cash flow, what part is from the sale. Sure. And on those value add deals, if you did that, it's 90% plus is from the sale.
Yeah.
So, there's a time and a place for those deals. And I mean, people who did those, in 2020, 2021, they did extremely well, and there'll be a good time to do those again. But I think that's why the multiple's lower. There's just less of a value creation, but also way less risk. We don't need to refinance. We don't need to rehab the property. Even if we did nothing and just ran it, we'd still, have I'm just estimating now, and probably an 8 to 10% return, if just running it. So that's like to me a great downside. Like, I like those deals where, kind of if nothing goes right, you still make 8%, but if it goes a little better than planned, you're in the high teens. So
yeah, that's amazing. Very good. Well, I feel like as always, we drone on too much early on, and then there's so much more that I want to cover, but I want to honor everybody's time here, and I still want to get through our final 5. So if you have just a few minutes left, I'd love to dig into that if possible.
All right, let's do it.
All right. So since our audience is primarily new or newer passive investors, do you have an educational resource that you can share with the audience that can help them on their education journey?
Yeah, I do. If I've made a 5 email course that is literally just for that person, where it's for new passive investors that want to essentially figure out how does this work. So it's not going to tell you like how to vet a sponsor or look at a deal. It's more just even more basic than that. And so that's on our website. You can just go to breneman.com, and that's there. And also there's a direct URL to it. It's just newinvestor.breneman.com. So that's what I'd say is where to go. And it's been really well received. So we've had before we started, over 1,000 people have signed up for that. So it's been, got a lot of good. And
I signed up for it myself, and it was fantastic. So I would second that and encourage folks to go over to the website and get that for sure. All right. What is maybe a favorite book of yours or a podcast you're listening to currently? And it doesn't necessarily have to be real estate.
Yeah, I think I'll still give this the one that made the biggest impact for me back in 2005. It's still out there. It's just called Real Estate Investing by Gary Eldred. Or actually, maybe it's Investing in Real Estate. But if you type in Gary Eldred, it'll come up. That book was the most. Yeah, it's Investing in Real Estate by Gary Eldred. It's about active investing, but it's just very practical and just it's where I saw a cap rate for the first time and cash on cash, and they also get into property management. A tip I remember, and then we stopped doing it at a certain point, but give your tenants a plunger when they move in is like a move-in gift. I remember that tip. I did that for quite a while. He's like, this is going to save you a lot of money. I was doing that up, for quite a while. That's
funny. Housewarming gift of a plunger. Never saw that before. Great idea though. All right. Good deal. What's a good due diligence question that folks should be asking that maybe is a little more advanced than the basics we always hear?
Yeah, I really think either asking about or just calculating yourself what is the untrended yield on cost on this deal. So basically going with no rent growth, like what if when they execute their plan, what cap rate are they getting this deal to essentially? So like a lot of times I'll see deals where it's a value add deal, but they have so much market organic rent growth built in on top of that then it's not that good of a deal, to be honest, starting out. Like, you're not getting paid enough for the value add. So I would, I don't know if I'll do it justice explaining. Actually, I made a more advanced email course that has the 7 questions I would ask a sponsor. I can throw that out if you want. Yeah, that's on our website too, just right where next to the other class. But that's also, if you go to masterclass.brenneman.com, that's where that email course is.
Fantastic.
And I don't know if I won't give it justice, because there's other things to ask about. But it's funny, usually the biggest investors I have, they ask basically the same 5 or 6 questions every deal. So that's what's in that email.
I love it. I'll go get that one as well. All right.
And then a couple of fun ones here to wrap it up. Do you have a recent bucket list item you've checked off your list, or one you're hoping to in the near future?
Yeah, I think so. I just bought a house and moved to it here in Austin. So I think I'll say that.
Yeah,
it's so fresh. I literally moved. Thanks. Yeah, this past weekend. So, but yeah, I've been to over 20 countries. Back when 2011 and 12, I went to a lot of countries in Europe and Asia. So I'm definitely due to get that going again. But I have 2 kids and a lot going on as well. But yeah, I'm definitely due to get some more travel bucket list things going.
All right. And then final question we like to ask everybody is, if you had $100,000 you had to invest today and you couldn't put it in one of your own deals.
Yeah, I really am all in on Chicago right now. And I have a buddy that I went to college with who does smaller deals, like let's say 4 to 10 unit deals in Chicago. And I've invested that amount of money and the number of deals from my IRA and 401k in his deals. So his name is Garrett Lee. You'll have to track him down on LinkedIn. He works for Essex Realty now. If you want to invest with him, but there's no course or landing page to send you to for him. But he's only taken money from people he knows basically at this point, as college buddies. Yeah. So yeah, those have gone well. And then it's maybe I need to take a class in diversification, or I have, half my retirement account and, 8% of my money in, private real estate.
Yeah. Keep all your eggs in one basket and watch that basket very closely. Right.
So, I mean, at least I know how to vet the deals, but it is funny on Garrett's deals. No joke. I do basically just see what yield on cost do we get this thing to, in year 2. And then if it's high enough to the, where cap rates would be, I know this is a winner already and don't look at the rest that hard. So, it's the metric.
Awesome. Well, Drew, this has been great. I didn't get to half the questions that I had for you, so we'll definitely have to do this again. But thank you so much for being on the show.
My pleasure. Thanks, Randy.
Awesome. And to the audience, as always, we encourage you to continue your education journey. And Drew provided a couple really great resources, so continue down that path. More importantly than that, though, we encourage you to make the decision to invest in your first or in your next passive investment. Both Drew and I are convinced that once you do, you will just wish you had started that much sooner. So be sure to join us again next Thursday for another great episode. And thank you again for joining us here today.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.